Global markets were hit this morning when ratings agency Fitch downgraded its rating on U.S. credit. The agency cited the government's growing debt burden and the deterioration of standards of governance. Let's bring in All-Star Charts president and founder J.C. Parets. J.C., always great to see you. I got to start out with the news of the day because that's what we're running with here. I have an idea of what you might be thinking about the debt downgrade and its effects on markets, but it's quite a bit different than what we saw in 2011. Your thoughts?
Yeah, I mean, listen, I think the market has bigger fish to fry. You know, this Fitch. Does anybody really even know that they existed? Like, let's be serious. Like, who are these people? So I think the market has bigger fish to fry. I think the market's proving that. I think that the pressure that you're seeing, we've already started to see over the last couple of weeks. We saw some strength out of the United States dollar, which has been the big safe haven. You're getting a bit there. And the S&P and the NASDAQ are under pressure. Not only are they below overhead supply from, prior cycle peaks, you could look back at the NASDAQ 100 right around 380. You look at the S&P 500 right around that 4550, 4600 level, which we are now. So this is a perfectly logical place for those indexes to come under pressure. Not to mention in pre-election years, this is sort of that lull from a seasonality standpoint, even in strong pre-election years. So this is a perfectly normal time for these stocks to correct. And let's be serious, the U.S. 10-year yield is breaking out, U.S. 30-year yield making new highs. When you have higher rates, that puts pressure on growth stocks, technology, communications, all of those areas that got us this far so far this year, which have been big winners driving those indexes, are going to be under pressure with higher interest rates. So you sort of have the perfect storm regardless of what these Fitch people say about anything, right? You see what I'm saying?
I see what you're saying. So let me ask you, you mentioned a bunch of different markets here. I want to focus, and you said the rates market in particular and the negative implications that would have higher rates for some of these mega caps that we have, the growth stocks, et cetera. But we have a number of other sectors that are already at record highs to little fanfare. We got industrials up there. We got SMH, that's semiconductors up there, transportation screaming higher. Tell me about some of these markets and what you're seeing in terms of the breadth of this rally.
Right. So the question really becomes, if these tech stocks and mega cap stocks are going to be under pressure, that means that the indexes are going to remain muted for the foreseeable future. Do some of those other areas like energy, like materials, even industrials that have much lower weightings in those indexes, are they going to be able to withstand the selling pressure coming from those growth stocks to be able to continue to progress? Can they do that? Or is this strong dollar, flight to safety, just so overwhelming that even those areas get hit too? That's sort of been my question coming into the back half of the year. In the first month, the best performers in the month of July were energy, financials, materials. Those were the worst performing areas in the first half. So you already started to see it. So the question was, is the selling that we're going to get in growth and tech too much for those other areas to withstand? I think we're seeing some of that today. Let's see if that sticks. But I got to tell you, a stronger dollar, if the U.S. dollar index is above 101.5 to 102 area, if the dollar index is above that, these indexes aren't going higher, right? I just don't see that happening. The negative correlation between stocks and the U.S. dollar has been through the roof for 6-7 years now. And to bet that that's going to stop, anybody who's tried to bet that is going to stop, and a lot of people have, pay the consequences. So I'm not going to tell you that correlation now all of a sudden is going to change. There's no evidence of that whatsoever. A stronger dollar is going to come with weaker stocks, Jared.
All right, well, let's talk about the commodities market. If we could go back to the Wi-Fi Interactive, I want to show what's happening with the Goldman Sachs Commodity Index. Big negative red candle today, but let's take a look at the year-to-date. You can see we got some liftoff in July here, and let's see if we can show the 200-day as well. We've seen commodities definitely perk up, and I've been talking to a number of other traders. Some think this is a harbinger of more inflation, a third round of inflation. What do you think, and how is this affecting the way you're approaching any markets?
Yeah, I mean, listen, part of the thesis coming into the back half was that we're going to get rotation into commodities and commodity-centric stocks as we're at washout levels in terms of pessimism. I guess we can get more pessimistic. I shouldn't say we're at washout levels, but we're pretty pessimistic levels when it comes to commodities, crude oil, inflation expectations. So my suspicion was we can start to creep up. You've been seeing inflation-protected treasuries outperform nominal yielding treasuries, kind of hinting towards higher inflation. Oil sort of perking up. As we're recording this, unleaded gasoline's getting hammered. Oil, let's see if they could stick this. And that kind of goes back to my earlier question. Can we see that rotation into energy and materials and industrials that we've already been seeing, despite the selling pressure in tech? If today's any indication, the answer is no. But again, one day doesn't make a trend, but sort of something I'm watching and sort of I'm questioning. I like the commodities trade, but but the question is, what's your time horizon? Like in the coming months or in the coming years? I think that's a big difference, because in the short term, if the dollar's strong, I have a hard time seeing stocks and commodities in particular doing well in that environment.
We got one more, and I want to go back to the Wi-Fi Interactive. Talk about Bitcoin here. Interesting price setup here. Let me go to a year to date so we can see the latest flag. We had a little bit of an undercut here. I think you have labeled this an oops on your chart. Well, what are you seeing in Bitcoin right now?
Yeah, I mean, it's certainly not an oops. If Bitcoin is below 30,000, it's not an oops. It's not a failed breakdown. It's a breakdown is what it is. And the path of least resistance is to the downside in Bitcoin. No question about it. Think about how much good news we had between BlackRock coming in and Vanguard and Fidelity and the new ETF and this just bombarded. I don't remember there ever being such good news in Bitcoin. And in that period, Bitcoin failed to break out, right? Failed 4 consecutive weeks in a row at 31,000. I said, you know what? That's enough for me. I'm good. I got out of everything. Now I started nibbling a little bit, but if we're not able to get above 30,000 in the next day or two, I'm out completely again until Bitcoin is finally able to convincingly break out above 30 and really 31 is the big one, and be able to stick that landing. In the meantime, I'd rather be not in. I'm not short, but I have no interest in being in. I mean, the downside is, you can go back to 20, go back into the teens, easy. I don't need that in my life.
I don't think I need that either. And the serious downside could be ahead if there is another big failure here. Always appreciate your time and great charting stuff here. All-Star Charts president and founder, JC Parets.